Hello, I'm John Conrad. With the market hitting all-time highs and the year almost ending, I thought I would go over some tax planning ideas. Before that, I wanted to give a little background so people could understand what tax brackets mean, and then also the difference between ordinary and capital rates. I think these are pretty simple concepts once you actually see them, so I want to go through and just explain them quickly and see how you can really take advantage. This should really benefit people who are retired or people who make less than about $100,000 a year. So let's get started. So here you can see the tax brackets for 2019. And I'll just point out here's a single filer, here's head of household, down here is married filing jointly, and then married filing separately. So let me just teach you really quickly how to read these brackets and then we'll move on. So first, if you're a single person and you had income up to $9,000, that's going to get paid taxed at 10%. And remember, what you're going to do is when you have your income, let's say you make $30,000 a year, you're going to subtract from that what's called the standard deduction. So the standard deduction is going to depend on whether or not you're single or married filing jointly, etc. Let's say that you're married filing jointly, so that number for your standard deduction is $24,000. Well, if you made $100,000, the way you're going to calculate what tax rate to apply is pretty straightforward, but I think most people don't know how to do it. So if you make $100,000, now you're going to subtract the standard deduction right from that. So that's $76,000. When you go there, then what you're going to do is you're going to look at where $76,000 lands on this chart. So you can see that there's a 10% and 12%. So for that $76,000, the first $19,400 is going to be taxed at 10%. The remaining amount from $19,400 all the way up to the $76,000 is going to be taxed at 12%. You're going to add those two numbers together, and then that's the amount that you're going to be subject to on taxes. So a lot of people think, oh, I'm in the 12% tax bracket, so that's the amount you have to pay on all your income. That's not right. The way the tax system works is on that first amount, you're going to pay 10%. On the amount that you're between here, you're going to pay 12%. Between $78,000 and $168,000, you're at 22%, and so on. So that's the first piece. As long as you understand that's very important. Now what we're going to go to is a thing called capital gains. It's also going to have a different tax bracket. So we're going to look at those in a minute. So now what you can see is basically the tax brackets for long-term capital gains. Here's for a single filer, and below is for people who are married and filing jointly. Now the first thing to know is what's the difference between ordinary and capital gains. The way I like to think about it is an apple tree. If you're selling the apple tree, which is everything, then that's going to be subject to capital gains. Usually ordinary income is either salary or it's the sale of those apples. So you're keeping the tree, but you're selling the apples. That's going to be ordinary income. If you're selling the apple tree, that's capital gains. And as you can see, there's a huge difference in taxation. So for example, let's go back to the married filing jointly person. In this case, the long-term capital gains rate is going to be 0% up to $78,000. So remember, under the ordinary tax brackets, that could have been subject to 12%. But in this case, it's not going to be subject to any taxes at all. And that's really where we're going to work this advantage for what's called tax harvesting, and I'll show you how to do that in a minute. But realize the interplay between ordinary income and capital gains. So the relationship between the taxation of ordinary income and long-term capital gains can be a little bit confusing. But let me show you basically how it works. If you look at this table, this says your income. And the tricky part is this includes ordinary income and capital gains income. So what you're going to do is you're going to take your ordinary income and your capital gains income and add those two numbers together. Let's say you have $20,000 of ordinary income and $30,000 of capital gains. So that's $50,000. Then you're going to look at it and say, okay, $50,000 is between these two numbers. So you're going to then only take your capital gain, which is $30,000, and multiply it by 0. The 20,000 is still ordinary income, so that goes to the other bracket, and you'll pay between 10 or 12% on that 20,000. Now, I know that's confusing, but basically you put your ordinary income first, and then the capital gain sits on top of it. So let's take another assumption and say you had $100,000 in capital gains. Well, if you had $20,000 plus in ordinary income plus $100,000 in capital gains, now you're going to fall between this 0% bracket and the 15% bracket. So again, what you would do is you'd say, okay, I've got 20,000 of ordinary, and then I'm going to use 58,000 of capital gains, which will fall in this category. And then the remainder is going to fall into this category at 15%. So this, I know it can be complex, but the way it's going to fall is you're going to actually put it into a 0% category for your capital gain, and then a little bit of it's going to be in 15% category as well. So now let me show you how to put this all together in a concept called tax gain harvesting. So if you're going to do tax gain harvesting, what it means is you know that you could potentially have some long-term capital gains. So let's say you've owned, for example, Amazon stock for a long time, and now you've got all this money sitting in Amazon stock. Well, if you had $100,000 in Amazon stock gain and you decided to sell it all tomorrow, and you also had ordinary income, well, that's going to be a problem because some of that capital gain is going to then get taxed at 15%, and you don't want that. So what you want to do is you want to make sure that you subtract your ordinary income from this number, and then the difference is how much stock of Amazon stock you want to sell. And the reason here is then all of that Amazon stock will be subject to a 0% tax rate. So basically what you're able to do is sell your stock but not be subjected to any tax. One other small point to remember is when I say your ordinary gain, remember to subtract out your standard deduction. So if you made $40,000 in income, subtract the $24,000 standard deduction. Then the difference is what you're going to sell the stock for your long-term capital gain. So what I want everyone to realize is that you should be doing this every year. And why should you do this every year? What you want to do is capitalize on the fact if you have the ability to be taxed at nothing. And this can be a huge advantage because if you just wait for 30 years, you could have stocks that have really gone up for a long time, and then you're going to be subject to a lot of taxes. I mean, they could eat into easily 20% of your taxes if you held something for a long time. On the other hand, if you're able to sell a little bit each year, then what you can do is be subjected to that 0% tax rate. And also notice what I'm saying is you don't have to just sell it and then go away. You can literally sell the stock and then buy it a short time later. And this is a huge advantage because then you can stay invested in the market. And so you can take advantage of all these movements up, but at the same time, you're increasing what's called a tax basis. So each time you're buying at a little higher price so that eventually when you do sell this stock, you really won't have, and for the long term and don't intend to reinvest, then you're going to have no taxes to pay. If you just buy and hold like so many real estate people say to do, you're going to subject yourself to this 20% tax rate, and that can be a real problem, especially when you don't have to. So that was the concept of tax gain harvesting. There's another concept called tax loss harvesting. Now the rules here are a lot more complex, so I won't go into it in too much detail. But the one advantage is if you sell a stock at a loss, it allows you to take a $3,000 ordinary tax deduction. So why is this a big advantage? What it's basically saying is you had this investment, and now you as this individual have lost money on the investment. When you sell that stock, you're allowed to reduce other ordinary taxable income by up to $3,000 a year. So the advantage here is you've suffered a loss, but you can also reduce your taxes. Now, if you're in a lower income tax bracket, that's somewhere in the neighborhood of 10 or 12%. But obviously, those ordinary income brackets can get up pretty high. So you can save those losses for years when you're in a higher tax bracket and then get that $3,000 deduction. Now, what I like to do is combine tax gain harvesting with tax loss harvesting. And what do I mean by that? Well, if after a number of periods you continually, let's say, are doing tax gain harvesting, so now you have a high basis. Once the stock market's gone up for quite a while, eventually it's going to go down. Now, if you weren't doing tax gain harvesting, what'll happen is basically your gain will just shrink. You won't have any tax advantage whatsoever. But if you've been doing tax gain harvesting the entire time, what you can do now is sell that stock at a loss. So instead of having just a gain that's not quite as high as it would have been, now you actually get a loss and you can reduce your ordinary income. So that's a huge advantage from where you were before. Now, the one thing with tax loss harvesting is you can't buy that stock back immediately. There's a window where you have to look forward 30 days and look back 30 days where you can't own the same stock in that period. So it's a little more difficult and the rules are a little more complex. Usually, whatever program you're with, TD Ameritrade or any of those will all have warnings and tell you that you won't be able to do it. And that's all going to fall under tax loss harvesting. And you can follow up with them to know more. So that's been the summary of ordinary gains and capital gains, and also how you can take advantage of them through tax gain harvesting and tax loss harvesting. So hopefully you can take advantage of that. Until next time, please enter any comments below. Thank you.